All right, everybody, welcome back. Today we are diving into those two words that always seem to get the financial world buzzing. Interest rate cuts.
Yeah, they might not sound as thrilling as, say, winning the lottery.
Right.
But believe me when I say this,
Okay.
understanding how these cuts ripple through the system, how they affect your savings, that's powerful stuff.
Absolutely. And one of the articles we have actually uses this really cool metaphor talking about the Fed giving the economy an adrenaline shot. So
Yeah.
we're not talking about like literal needles here, but it's that idea of giving the economy a boost, like a jump start.
Right, and it makes you wonder, right? Because on the surface, the U.S. economy seems pretty healthy. So why the sudden need for a boost? Well, our sources actually point to a few things driving this decision.
Like what?
Well, first, there's inflation. It's cooling down, which is good, but it's still a concern. Then there's the whole job market situation.
Right, because a strong job market is good, a weakening job market, not so much.
Exactly. And even though things look okay overall, there are some early warning signs. And of course, we can't forget about our friend, the global economy.
Because what happens on Wall Street doesn't just stay on Wall Street.
Exactly. And right now, China's economy, well, let's just say it's facing some headwinds. That has implications for everyone, including us.
So it's like a giant game of financial dominoes. Everything's connected.
That's one way to put it.
And speaking of connections, that Seeking Alpha article, it actually dives into some interesting stats, like second quarter GDP growth, a very respectable 3%. Projections for the third quarter, 3.1%. Not too shabby.
Not bad at all. But remember those warning signs in the job market we talked about?
Yeah.
Well, the unemployment rate right now is sitting at 4.2%. Now, that's a pretty big jump from the 3.4% we saw last year, so that's something to keep an eye on.
Definitely. And then there's that whole China situation.
Right.
Their stock market, specifically the CSI 300 index, just saw its biggest monthly surge since 2008, up a whopping 21%.
Wow.
Yeah, and this comes right after Beijing announced a bunch of new stimulus measures to try and boost their economy. So yeah, even when things seem good here, we're still tied to the global roller coaster.
We're all connected. And you know what? This is where things get really interesting for you and me and everyone listening, because these rate cuts, they're not just numbers in a textbook.
Right, they impact real people.
They impact how much interest you earn, how much your money grows.
And you know what else? We've got to talk about those juicy 5% APYs we were seeing on CDs earlier this year. Remember those? Feels like a distant memory now. Like finding a $20 bill in your pocket, only to have it get sucked away by a vending machine.
It's true, those rates are definitely getting harder to find. Bankrate.com's data shows a pretty clear trend. Those high rates are becoming more and more scarce.
So what's a savvy saver to do? Should we just accept our fate of shrinking returns?
Absolutely not. It just means we need to get a little creative, explore our options.
All right, so first up, let's break down those CDs, or certificates of deposit, for those who don't speak acronym. Now, I know CDs sometimes get a bad rap, like they're the financial equivalent of dial-up internet.
Right, like they're stuck in the Stone Age or something.
Yeah, exactly. But are they really that outdated, or is there a method to their, dare I say, boringness?
Well, I wouldn't call them boring necessarily. They offer something that a lot of people crave, and that's stability. Especially in today's market, which feels anything but stable, that predictability can be pretty valuable.
Okay, so CDs, they're like that reliable friend you can always count on, right?
Yeah.
Not the life of the party, but they'll always be there for you. But just like with that friend, there's got to be some trade-offs, right?
Well, with CDs, the trade-off is flexibility. You're locking your money in for a predetermined amount of time. And if you need to withdraw early, be prepared for some penalties.
Talk about a buzzkill. It's like planning a fun road trip, but then realizing you forgot to pack snacks, and you're stuck with nothing but stale gas station pretzels.
And don't forget about that other CD pitfall, automatic renewal. You don't want to get hit with a pathetic interest rate just because you missed a notification.
Oh man, I've been there. It's like ordering a pizza on autopilot and then remembering you wanted to try that new salad place down the street.
And then there's that little thing called minimum deposit requirements.
Right, because not everyone has a giant pile of cash just lying around.
Exactly. Some CDs want a serious chunk of change up front.
Okay, so CDs, they're stable, but they come with some strings attached. Makes sense. But what about those high-yield savings accounts? They sound a little more my speed, a little more flexible.
They are definitely more flexible. You can generally withdraw your money whenever you need to, no penalties. And their interest rates, while not always as high as some CDs, they usually beat out those traditional savings accounts.
So it's all about deciding what matters most to you at that moment, right? Flexibility versus a potentially higher return. Decisions.
Exactly. And while we're on the topic of unique savings options, we've got to talk about those I-bonds. Everyone's talking about them, and for good reason. They offer a really interesting way to potentially stay ahead of inflation, which is a big deal right now.
It's like they have this superpower, right?
Yeah.
They can adapt to whatever inflation throws at them. But how does that even work?
So I-bonds have this two-part interest rate, a fixed rate, which stays the same for the life of the bond, and then a variable rate, which adjusts every 6 months based on, you guessed it, inflation.
So you get the best of both worlds, some stability and some protection against inflation eating away at your savings.
Right. If you buy an I-bond before the end of October, you can lock in a 4.28% annualized rate for the first 6 months. Not too shabby, right?
Not shabby at all, but I've learned that in the financial world, there's always a but coming.
You're right about that. There is a little catch. That 4.28% rate, it's expected to drop in November.
So if you're thinking about I-bonds, now might be the time to act. So the clock is ticking.
Yeah.
But even beyond that November deadline, there's another I-bond quirk we should probably mention.
Yeah, that's right. You know that thing where you can use your tax refund to buy paper I-bonds? Yeah, well, that's going away in 2025.
Oh, wow.
So if you've been thinking about using that strategy, now might be a good time to dust off those calculators.
So many things to consider with I-bonds. I feel like we need to hand out a cheat sheet with every episode.
That's why we do these deep dives, right? To break it all down.
Exactly. Because knowledge is power,
Yeah.
especially with all these financial decisions.
Couldn't agree more. At the end of the day, it's all about giving you the information you need so you can make the best choices for your own situation. Whether it's CDs with that steady reliability, I-bonds with their inflation protection, or any of the other options out there.
Right, because there's no one right answer. It's all about figuring out what works for you, what aligns with your goals, your risk tolerance.
Exactly. And speaking of risk tolerance, that's actually a perfect segue into something I wanted to touch on. We've been talking a lot about maximizing your returns, which is obviously important,
But there's always a but.
but we also need to talk about risk. How much risk are you comfortable taking on? Are you the kind of person who sleeps soundly knowing your money is tucked away safely in a CD? Or do you like a little more excitement, a little more potential for upside, even if it means a little more risk?
It's like choosing between a relaxing beach vacation or a wild backpacking adventure.
Exactly. There's no right or wrong answer. It's all about figuring out your own personal risk appetite.
So true. Well, on that note, I think it's time to wrap up this deep dive. We've covered a lot of ground today, folks, but hopefully you're walking away feeling a little more informed, a little more confident about navigating the wild world of interest rate cuts and saving strategies.
And remember, you don't have to do it alone. We're here to help you navigate the twists and turns, make sense of it all.
Absolutely. Until next time, happy saving, everyone.